Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, February 11th, 2016. I wanted to take a look at the Huey index from a long-term chart. Choosing the Huey here for those familiar with it. Before the days of GDX, and the proliferation of all these ETFs that we have now, we just had the index itself, and the Huey is the gold bugs index. So GDX, I think, started trading in 1996. So here we're going back. This is a 20-year chart going all the way back to 1996, using a monthly time frame. And there's so much in this chart. I wanted to put it up in static form and hit on a few key points, but there's just too many. The chart would be painted with so many annotations and notes that you wouldn't even be able to see the prices below it. So let's go. Let's dig in. I'll start from the bottom up. The good stuff is really up at the top, I think, when I talk on the moving averages and some of the different the price action. But I'll just start down at the bottom. We'll work our way up. This is an ROC 25, rate of change 25. On my index charts for the U.S. equity indices, I typically use an ROC 12 or 13 on the monthly time frame. But on the gold mining stocks, they're a whole different animal. So they trade differently. And I play around with the numbers, and I just find that the ROC 25 fits with the fewest amount of whipsaws. Whipsaws meaning a buyer, a false buyer sell signal. So you can see this is pretty clean. The trend, and again, these aren't standalone buyer sell indicators. ROC 25 doesn't get you in early, gets you out a little late, but it does help define the major trends, the primary trends in the gold bug index. So you can see we were in a bear market all the way in the late 90s leading up to about early. Well, it really ended just before the beginning of 2001. And this indicator flipped. It had a little blip right there, but finally went solid at this point here. And as you can see, captured the bulk of the trend. So this doesn't look like much. That it actually looks like a whipsaw signal, but it's not. If you put the crosshairs at this point, didn't get you out at the top, but it had you avoid the worst of the sell-off and when the miners just collapsed during the financial crisis. Had you followed the signal, you would have been out and missed that huge, massive candlestick there. And then it did a pretty good job of turning around and getting you back in and catching the bulk of the move up. A couple whipsaws here or there. I've measured these out. You can do it on your own. Believe it or not, these weren't really whipsaw signals. They would have captured a drop, if I'm not mistaken, at 20% or more. Now, by most metrics, when people talk about a bear market, they use a drop of 20% or more from the highs. 20% is just a run-of-the-mill move for the miners. They're so volatile. So, but again, like I said, these, if you want to look at it as that type of trading vehicle, if you're happy with a 20% move, or at least avoiding a 20% loss, if you were long, some of these signals actually would have done that, even if they appear to be whipsaw signals. But again, just look at the bulk. Follow these lines, see the curvature of the lines. It doesn't always work because this was a strong trend. It went down, looked like it was going to cross, but it never did. But at least when you see the bars moving down, you are on alert for possible trend change, and this is just one. I use this to confirm the overall trend, and then you use your weekly charts and daily charts and everything else to really hone down your entries and timing. So there's a trend that flipped bearish at that point, and as you can see, it would have gotten you short for the duration of the bear market. One little whipsaw there. Again, it was a pretty big move, but most importantly, we're still, obviously this is heading up. Looks like the trend right now is up on that rate of change 25, ROC 25 monthly, and it may cross bullish soon, but it hasn't yet. So just point number one, verifying that the mining stocks are still in a bear market by that metric. Yeah, there's other metrics, but again, by that metric. PPO. The PPO I use in lieu of the MACD on a monthly time frame, a weekly time frame on a lot of charts, even occasionally on daily charts. It's almost identical, works very similar to the way the MACD works. It just has a different formula to calculate it, and it does a better job of capturing large moves. Here, I'll show you real quick if you're not familiar with what I'm talking about. This is a MACD, and look how flat. Look at the different separation in the lines on the MACD. Just doesn't do as good a job in the long run. Right here, you can see better separation there. You can make out the divergence that I have here. So again, and on some charts it does even a better job, the PPO and the long-term time frame. But again, my preference on longer-term charts. Okay, enough of that. You can see multi-month divergence, although I don't have the upper line drawn all the way out. You had it from this point right here, where the PPO and the RSI both peaked. Prices continue to make higher highs all the way up until the highs, and that really essentially you take the divergence here, you take this uptrend line, and that's just a very large bearish rising wedge pattern. And it's amazing, or I should say it never fails to amaze me, how well technical analysis, the same chart patterns that work on a daily time frame or a weekly time frame or even a 1 minute chart work just as well in the monthly charts. No different. So, and again, they're not 100%. Nothing is. That's why we have different things to help confirm the trends, to help, if we look at a falling wedge pattern, is it confirmed with divergences or not? Those are the kind of things that help increase the odds that a chart pattern that you're watching will or will not play out. So, in a general rule for measuring a move on a wedge, you take the widest point of the wedge, and you add that to the breakdown. And again, I've seen it done both ways. I've seen it from the top of the wedge, but I like to add it to the bottom of the wedge, and that tells you that you can see that this bear market has pretty much most likely run its course, and that's the case I've made. There's also some support. You can see some reactions back here. So again, I've made the case that the bear market is most likely over in the mining stocks. We just don't have the evidence right now, and that's what I'll finish up on here. So enough of that. Let's get rid of this line and get back to the PPO. Just like the MACD, for those of you not aware, the reason they put a zero line in here in the MACD is that it's very simple, but if you look at the MACD or the PPO trading above or below that zero line, that often defines the trend. And check that out with a lot of stocks. Look at the indices, and on just about any time frame too. Use it on the MACD on the shorter term time frames. Now I'm looking. I usually find one or the other of the lines that work better. In this case, it's the white line, which is the 9 EMA, the signal line. So if you wait for a cross there, and I say that because you had a whipsaw signal there. Now, of course, the PPO line would have given you a little earlier entry because the signal line crossed the zero line later. But as you can see from here all the way over to this point, if we're going by the 9 EMA, that captured the bulk of that mega bull market in mining stocks. And then once it crossed, they actually both crossed around the same time. That would have been an indication for those non-believers that, hey, most likely you can also follow this line down and you see the ROC 25 confirmed. We were short the miners up there on the site officially, before that happened, due to breakdown on the daily time frame. I believe it was the ascending broadening wedge pattern in the GDX was our short entry. Actually, a partial rise into that ascending broadening wedge pattern. I'm sorry. Okay, so that's one thing to look at, and as you can see, we are deeply still down into negative territory, way far below the zero line. The other tool to use with the PPO as well as the MACD are the bullish and bearish crossovers. So you have a bullish crossover here. I'm sorry, that's a bullish crossover. We had the orange line cross above the 9 EMA right here. And that was early on, and it kept you in. The orange line stayed above, tested the white line, the 9 EMA from above, and didn't make a bearish cross until this point. And then from here, it stayed bearish all the way to this point. Now, that didn't get you a great entry for short, but it did get you out of this, what I would refer to as a painful sideways consolidation, especially if you're not an active trader. If you're trying to trend trade and catch the bulk of these moves, as you can see there, it told you to get long here, get out here, and not get back to right here. And then there was a little bit of a move up, and then we had some. That's when it goes flat, by the way, just a sidebar here. I stay away from using this aspect of the MACD or the PPO unless there's a lot of separation. That's why I talked on a minute ago why I prefer to see separation on these lines. Why I'm not using the MACD here, but here, so this is flat. You get these whipsaw. You tend to get these whipsaw signals, and that also comes from flat prices in a trading range. But it's these sharp moves. So then you have a separation. You get a bullish cross right here. So you go long, and at that point, if you're long on this signal, you're going to stay long until you get a crossover, and that didn't come to that point. So again, follow the horizontal lines up. I'm putting the crosshairs on the bullish and bearish crossovers. So there was your sell signal, and it didn't tell you, and although it was a whipsaw signal, it didn't cross back over to here. So given, if you were trading on this alone, which once again, you wouldn't use this as a standalone buy and sell signal, at least not in my opinion, but you would use this as confirmation. Yeah, you had a little bit of a whipsaw here. It looks like it barely crossed over, but it went back down. And again, it's still below, but it looks like it's poised to cross now, but hasn't yet. And it's below the zero line. Okay, let's continue to move on up. I already pointed out the divergences. Not much else to say on the RSI. The RSI is... well, there's something I'll add here. Like I said, there's so much you can just put in the charts all day long. Let's see if I have that at the 50 level. It's almost there. Edit. The 50 level, a lot of RSIs don't put it on the chart. I'll add it here. Let's see. Okay, I had to pause the video to get, but I did set it. It's now on the 50 level. You can see there. The 50 level in the RSI often acts as support and resistance when tested from above or below. So bear market, you're below. We had a breakout, back test. So the breakout was your, one potential signal that the downtrend was over. Back tested the 50 level and then went on. We came back, and you can see a slight little overshoot, but for the most part, throughout the bull market, the RSI remained above the 50 level. There was the bear market, which was very swift and severe back in the financial meltdown, and it took us well below, and then we got back above in the next bull market and remained above up until that point. And we had one little whipsaw right around the 50 level. Remember, these things aren't perfect, but that's done a pretty darn good job. Where are we now? We're a little ways below it. We're at 45, under 46, so we're not even there yet. We can come up and back test that. So 1, 2, 3. Now on the third, at least the third, if not fourth metric to confirm that the primary trend right now in the miners is still down, and hence I'm not chasing the mining stocks long. In fact, still looking for a pullback here, but completely on guard, because these are really pointing to the fact that a bull market is probably about to be underway very soon. So I'm again looking at the long-term time frame. All right, a couple other things. We'll wrap it up. The trend indicators. Up here I have a 20 and a 17 period monthly average, moving average. So again, monthly chart using a 20 and 17 period. I'll look at the pair first real quick. The pair, you just use a crossover. Anytime the purple line, or I should say the yellow, let's say the 17, which is the faster EMA, when that's below the 20, you're in bear market status. So you're below. Here's a crossover, and you can see if you zoom in closely, the yellow line stayed above all the way. They kissed here, maybe a brief whipsaw, but for the most part remained above. Now of course we had a crossover there. Let's see, bearish crossover came a little late, but put you back in. Again, it's done a pretty good job, and as you can see here, we crossed back over. The 17 crossed below the 20 back, about April or so, and has remained below since, and continues to remain below. Again, one more metric I'm using that's pointing to the fact that the gold mining stocks are still in a bear market. And, you can look forward ahead, and yes, this bear market won't last forever. None of them do. But that's all I'm trying to do is look at this as objectively as possible. All right, and finally on that, I'll do this. Let's tune this one down in color. All right, now this to me is probably one of the most important indicators on this chart. I shouldn't say the single most. If you want to use a very simple tool, this 20 period moving average, again, monthly moving average, has done just an excellent job of defining bull and bear markets. Now, what I'm looking at, and the way I read and use moving averages, whether it's on a monthly chart like we're talking about here, a daily time frame, I look at where prices are and where they close relative to the time period we're trading. What do I mean by that? I'm talking about ignoring candlestick tails in wicks, i.e. shadows. You have a candlestick body, that's the thick part in the middle, and then you have those thin parts below and above. They're referred to as shadows, or you call them wicks above, because it's like the wick on a candle or a tail. So let's take a look. This only picks up right here on TC2000. For some reason, they don't populate till they had enough periods of candlesticks to start the line. But you can imagine it was there. We were in a bear market, and here was an attempt. Now we closed ever so slightly above it there. Call it a whipsaw if you want, and then close back below it the following month and stayed below it. And you can see how many candlestick shadows came above there, how many wicks pierced above it. And also how many kissed it. We have a lot of candlestick, the wicks kiss it from below. Finally, when we break through, as is usually the case when you break an important technical level, you see an impulsive move. And then once that happens, just follow the mouse along. We come back. Here's a near test to that level right here on this big red candlestick. A very nice test, even an intramonth break. And these can be pretty bullish things when you have these intramonth breaks, but yet prices manage to close back above, which they did in this case. You can see the candlestick body, as is the following 1, 2, 3, 4, all managed to close above it. And look at all those candlestick tails. Those false breakouts. They're not false breakouts unless you took the signal, and that's why I said don't take a monthly buy or sell signal until, if you're trading that time period, until the month is closed. So we broke down. Now this might not look like much. You might want to call this a whipsaw signal, but let's just do the math here. I'll grab that candle where it closed below, because it's a red. If it's a red candlestick, the close is at the bottom of the body on the candlestick, and the one I just grabbed, prices were below the bottom. And so from that point to the lows, that was a 20.45% drop. So in technical terms, that was a bear market. So that's not a whipsaw signal. It got you out, averted a 20% loss, and then got you back in here. You can see test, boom, impulsive break above, and then look at all the kisses, kiss, hammered it right back on there. I mean, maybe a hair below because the red closed, but again, you're splitting hairs. And if I was trading off this frame, I would have waited for follow through. I wouldn't wait for a 0.01% close below that line. You want to see a pretty solid close, an impulsive move like this. You can see kiss here and a breakdown, and this is where we closed, the bottom of that body of that candlestick, and we went that far down during the month. That was a great exit. And then back here, an impulsive. This was an impulsive stick. It closed well above the line. And yeah, you had a little fake out the next 2 months, but then back above it. So again, there's nothing perfect. There's a few whipsaws that come in here. But for the most part, if you use this as a trend indicator, you can see just how beautiful this has done a job. And again, exclude those wicks. Look at the body, where the body closed. Or if you see a wick that kissed it, like back here, a kiss on the top, kissed it. Pulled back, and here we are right now, intra-month. We're only not even 2 weeks into February, but right now we're at that level. And then the last thing I wanted to talk on is price resistance. During uptrends and downtrends, you have these reactions along the way. So here was a reaction back in 97. So if you put a horizontal line there, you'll see to the right, once we broke below that level, you see numerous intra-month breaks, meaning these candlestick wicks here, but all the bodies and or wicks, hit that level and bounce back down and close below it. So that was resistance, fell back down, moved back up, and you can see there was some consolidation here. So that's you have those recent lows. That was resistance. Finally, we punched up above it, and an impulsive move came up. Hit. A lot of these lines were drawn because of these past reactions. So I can't tell you if to the left of the chart what was happening at the time, but I can tell you these were levels I've been watching since. And as is usually the case, nothing goes up forever, so you consolidated, chopped around for a few months, back and forth, and then finally broke above that reaction high. And as you can see here, look at that big green candlestick, a very impulsive move. This is what you want to see on a breakout. Just like we had here. We had a recent consolidation period, and if I cut off these few wicks that came above, look at all the bodies that closed on that level there, and that's exactly what you want to see in a breakout. So I am all for this breakout. longer term bullish. The only problem is, look where we're at right now. We ran smack into this resistance zone. Let's clear it out here. These two lines are a resistance zone and a very well-defined resistance zone. We have this recent cluster back in 2014, 2015 of those reaction lows. We have the 2008 lows, 2 monthly candlestick bars define that level. Go all the way back to 04, go all the way back here. So this is a very solid resistance zone. Very bullish if and when we take that out, and I do expect that to be taken out over time. I just don't think we're going to go up and go right through it like it's not even there, as well as right through this 20-month moving average like it's not even there. So hopefully that puts my thought process into perspective. And just to wrap it up here, if we, if and when we get through there, we have, oops, grab the wrong tool. We have the next resistance is right there at, at that cluster. We have reactions from above over here at that level and from below. So if and when we punch through, what my ideal scenario would be is a pullback here, work off the near-term overbought conditions, and then power on up through that level, then have a reaction there, pull back. That will have taken us above the 20-period monthly average. It will have taken us above the downtrend line off the highs. This is where I would say a new bull market has begun in mining stocks. We're right there. We're on the cusp of it. It's just a little too early to declare that right now. So those are the things I'm looking for. And, I'll keep this chart updated from time to time. And if you have any questions, just shoot me an email or reach out to me in the trading room. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed.